house on my own.
Sorry.
It's okay.
You're good.
Okay. So anyway, that's just our goal. We always want to work with our clients to be a tool for them in whatever that they're doing. I told Kim that we work with many realtor clients. Some of them are business owners with their own teams and they have employees. Some of them are part of a team as W-2 employees, and some of them are just on their own with no employees. So we see it all. We have a good understanding of what kinds of questions you might have, especially at this time of year when taxes are top of mind. Probably the bulk of what I have for today is more focused on the business owners. But if you're not one now, maybe you will be in the future, and this will hopefully still be of some benefit to you. I'd also mentioned to Kim, and full disclosure, I do love doing these workshops because hopefully I give you some ideas of questions that you should be asking tax professionals or things you should just be thinking about in your own lives. And I am happy to answer any general questions either throughout this. If you have a question, please feel free to ask, or at the end. I can't give any specific tax advice today. Instead, I might just advise you to consult a tax professional, or you can reach out to me afterwards too. That's totally fine as well. So I talked to Kim about some topics that you might have questions on. She said probably generally just where to start. I mean, like just where to start with taxes, I guess. But we decided that just thinking about best practices and record keeping would be a good place to start, especially because keeping good records is a best practice of owning a business. And we see, especially with our realtor clients, different ways of tracking activity. Some track on a spreadsheet throughout the year using a cash receipts and disbursements method. Some use an accounting software such as online QuickBooks. And some, I think, an email from me in January that I need their profit and loss, and they go through their credit card statements and bank statements right then and there and put it together. So really what it comes down to is just how complicated the tax situation is. No one's is the same. It's probably easier for a single realtor to track everything in Excel versus a team of 5 versus a team of 20 and so on. As you grow, you probably are going to want to look at the accounting service route, such as online QuickBooks. We in our office typically recommend using QuickBooks. Everyone in our office is trained on it, so I can't speak for other firms, but then that way, if you're ever doing something and you have a question, you can call us and we can hop in and see what you're doing. It's also, it can seem a little daunting to start at first, but it is very user-friendly, and it's just adding expenses, and it just is another tool for you to use so you can, you're selling homes, but you also want to be able to grow in the future. So that's why we typically recommend QuickBooks. We also typically recommend that you stay on top of your books at least monthly, if not weekly. And what that means is entering your activity, both income and expenses, reconciling your bank and credit card accounts, and just making sure that everything is in there. So then, right now I'm thinking at tax time, you want to make your accountant's life as easy as possible, because then it won't take as long to do your taxes, and there's just some assurance that everything is right. So we, in our office, we always want to tie your balance sheet items, that's your bank account, your credit cards, to a statement so that we know that everything on your profit and loss, it might be in the wrong bucket. You might have categorized an office expense as a selling expense, for example, but it's there and your bottom line will be right. So that's why we recommend staying on top of this, because if you wait until December, this becomes a very daunting task to go through 12 months to put all of that together. And the other reason, besides just taxes, and not to turn this into an accounting 101 lecture, but we want you to be able to look at your financial statements and make business decisions from them. So probably, especially if you're using online QuickBooks, the two statements that you would most likely use are a balance sheet, which is a snapshot of your financial position at a specific point in time. So again, that's your bank account. Right now, I'm asking clients for balance sheets at 12/31/23 because I want to see what they had in the bank at 12/31/23, whereas their profit and loss statement, or their income statement, it's also called, shows the revenue and costs over a specific period of time. So while I'm asking clients for balance sheets at 12/31, I'm asking for a P&L for the entire year. If I'm going too fast, someone please ask questions too. And the reason that that's important and looking at those financials is important is because as you're tracking your activity through the year, if something's different than it has been in the past, you want to be able to catch it. Because let's say the market totally flips and all of a sudden you're selling triple what you did the year before, you're going to have substantially more income than you did the year before, which means you're going to have substantially more tax than you did the year before. And as busy as we are this time of year, the time to make decisions is actually before the year closes. So if you're tracking it during the year, you can actually do something to mitigate the tax liability you might have. We can make decisions before the end of the year that might not be available now post 12/31. And so part of that is tax planning, which that is my personal favorite thing of what we do here. Is right now until April when we prepare returns, we have what happened and that's it. Whereas tax planning, we can make some decisions that maybe you hadn't thought of or maybe didn't apply to you last year, but now you're above certain income thresholds and it does make sense to you. And it's significantly easier for us to run a projection if we have some records to refer to. So obviously no one has a crystal ball, especially in your industry. But if we can be confident in something that's already happened in the past and build from there, then you already have a leg up. Whereas if you're just totally estimating what you've done for the entire year and you haven't put those records together, it makes tax planning a lot harder. And the reason that we want to do tax planning, besides, hopefully your income's growing and your tax is growing, which I say hopefully your tax is growing, that is a good problem to have. It means your income is growing. But we want to make those decisions to maybe keep more money in your pocket. And I'm talking about things like if you're a single member LLC, maybe it's time to make an S collection. Maybe we should be looking at some retirement plan options for you. Should you be running bonuses either for yourself or your employees? If you are a pass-through entity, does it make sense to make a PTET election with New York? And also just to manage your cash flow reserves in general, because if you do have a tax liability, you need to know to build up those funds. So even if you're not interested in professional tax planning, like I said, it's certainly useful to you as business owners to be able to look at your reports during the year to have an idea of where you stand. Going hand in hand with good record keeping, probably the number one recommendation we make for any client in any industry with his or her own business is to keep your personal and business finances completely separate. As I mentioned, we tax professionals want to be able to rely on our clients' records, and for our corporate and partnership returns, we do tie out every single line on the balance sheet to ensure that we can. But it is so much harder to do so when there are business expenses through the personal account or personal expenses being run through the business account. So we recommend always opening a separate bank account and separate credit cards specifically for the business. And just, obviously, sometimes you might have to use a card. Just make sure that you're reimbursing it or you're noting, trying not to run personal expenses through the business account. If you're ever audited, you don't want the IRS to see that you are using your business account as a personal account. So that is definitely our number one recommendation, not just for realtors, for any client in general. And then if you do go with an accounting software like QuickBooks, we recommend setting up your accounts in a way that makes sense to you so that you can make decisions based off of that. For example, I work with a bunch of realtors who use coaching to help set up their chart of accounts on their profit and loss statements. And they do that so that they can compare their profit and loss to another team's more easily. The result of that I have found with my realtor clients is that their profit and loss statements are very long, which is totally fine as long as they're getting the benefit that they want out of it. What I mean by that is, one client in particular has an expense account for lead generation, but their total lead generation expense doesn't mean as much to them as knowing what kind of lead generation costs they're incurring. So this particular client has set up a lead generation as an account with sub accounts for general marketing or print and direct mail or internet leads, what have you, just that year after year, they can see where they're spending their money. And that's totally fine. She's getting a benefit out of it. What I do when I prepare the returns is I'm putting just lead generation on the tax return. So that breakdown doesn't mean as much to me, but it means something to her. So it's worth it to have it on her P&L. I do point that out just to say, because in that example, it makes sense. But as you set up your accounts, you don't want your profit and loss statement to become overwhelming to you. It probably doesn't make sense to track office supplies, breaking down what you spent on pens versus paper last year, and just calling it all office supplies makes more sense than that. So that's just one thing I've seen, especially with the realtor clients, is that your P&Ls do get long, which, again, totally fine if you're getting the benefit out of it. I would just be mindful about what you really care about seeing, because that is the great part of having, especially QuickBooks, is that you have these reports that you can compare year over year and see my top line's growing, but why is my net income not growing? Oh, I'm spending way more in lead generation, just to go back there. And lastly, for record keeping, just an FYI, the IRS's period of limitations for assessment of tax is 3 years from the due date of the return you filed. So your 2022 return was due, if you're an S Corp, March 15th, 2023. That means the IRS has until March 15th, 2026 to audit those returns. So at a minimum, you should be keeping records for up to 3 years. We typically recommend 5 to 6, maybe even 7 years, just to be safe, to err on the side of caution. This would be any receipts you have, any 1099s you receive. If you're a W-2 employee, it's your W-2. Anything to help substantiate the income and deductions you're claiming on your return. I, as a tax professional, don't need the box of receipts when I go to prepare your return, but we recommend our clients just have a file, 2023 expenses, and they keep everything in there. And that's just so that if you ever were audited, you have all the backup to support. Hopefully you never are audited, though. Any questions so far? Okay, so another thing Kim mentioned you might all be interested in are just some common deductions that we see, especially among our realtor clients. Some, I don't want to say obvious ones, but top of mind ones, I guess, would be the commissions you pay to other agents, your desk fees, marketing and advertising. That would be like staging, photography, signage, anything that's, you need to actually sell a house and also promote your brand. Your office supplies, memberships and licenses, training and continuing education courses. Those are all expenses that we typically see. Additionally, some other expenses you might not have considered. If you conduct business out of your home, you might be able to take advantage of the home office deduction. This is for the area for which you are claiming business. This is for the area of your home that's specifically used for business. So we look at, let's say you have a home office, it must be exclusively used to conduct business per the IRS and on a regular basis. And the home must be your must generally be your place of business. So for me, for example, I'm not an owner of this firm. If I was, I would not be eligible for the business use of home because this office is our primary office. So, but if you are working primarily out of your home, then that's something that you certainly could look at deducting. And that applies not only to homeowners. If you rent, you are eligible for this deduction too. There are two methods of calculating this deduction. Our office will look at both on a client by client basis. The first is the simplified option, which is just simply applying a rate of $5 per square foot to the business square footage of your home for a maximum of 300 square feet or a maximum deduction of $1,500. The second is the regular method, which the deduction is based on the percentage of the home devoted to business use. So if you have a 300 square foot office and a 1,000 square foot home, 30% of your home expenses would be this deduction. Again, that's something we look at on a client by client basis, because there are other factors to consider than just the total deduction amount. Another big expense we typically see for realtors especially is mileage. You are all probably driving for various showings or meetings all the time. I'm sure your miles add up quickly. So like with business use of home, there are two options that you can take for auto expenses. The first, and the one we typically recommend just because it is the easiest to track and to substantiate, is taking the standard mileage rate. For this, you take your total business miles driven during the year and multiply it by the IRS's annual mileage rate. For 2023, the mileage rate is 65.5 cents per mile. For 2024, it goes up to 67 cents. Alternatively, just like with business use of home, it might be beneficial to look at your actual auto expenses and deduct the product of those by the percentage of your business miles over your total miles. Again, that's something we look at on a client by client basis. There are other factors that go into deciding which one to take beyond just simply the largest deduction. We do, like I said, probably most generally recommend the standard mileage rate just because it is easier to track and keep a record of. Another common deduction we see are meals. So this includes meals when you're traveling on business and when you are dining with clients or other professionals for the purpose of conducting business. So one big change for 2023 is that for the last 2 years, meals were fully deductible. For 2023 and beyond, we are back to meals being only 50% deductible. But still, I'm sure many of you are having lunches with clients, and it's worth keeping those receipts and taking those deductions. So those are probably the most common deductions we see when preparing returns. I know I just threw a lot at you. I'm happy to answer any questions you might have now. I can also give my email address and phone number in the chat box if anyone wants to connect separately. That's, like I said, I can't answer any specific tax questions. I am happy to answer any general questions. I do know too that tax time can seem daunting and stressful, but hopefully this has helped you become aware of some things you should maybe be working on in your business or questions you should maybe be asking a tax professional.
Hi, Kara. Can you hear me?
Hi. Yeah.
I have a question about mileage versus gas expense.
Mm-hmm.
If you fill your gas tank up, for example, and you go a certain amount of miles for your business, you then would have to reduce the you have to calculate the mileage as it relates to the gas money that you spent. Am I getting that right?
Yeah, I think you might be combining. So if you're taking the standard mileage rate, I would not run the gas on your business card at all. I would, either annually or monthly record what your mileage was for whatever period you're doing and multiply that by the IRS's mileage rate and reimburse yourself. Whereas if you are taking actual expenses, you still look at your business miles over your total miles driven, and you can take a percentage of the gas that you paid for. That would be part of the actual expenses. But yeah, no, so if you are running the gas through the business account, you do have to back out the portion that would be for personal use.
Okay, so if you are taking the mileage, the IRS allowed standard mileage allowance, I should
Yep.
say, you cannot take gas as an expense.
Right, that would be double dipping.
Okay,
The gas is built into the mileage rate.
okay. Great, thank you.
Oh, you're welcome. I'm just putting my email and my direct line in the comments in case anyone does want to reach out separately.
I have another question.
Oh, okay, yeah.
If you have a home office, do you have to justify, or, I mean, is it just if you're sitting in your office to do your work, that's allowable? If you don't have clients come there, does that change the picture?
So it's if you're going out to meet clients, you're not showing them a home in your home, but you're doing your admin work in your home and you don't have
Yes.
another place to do the admin work, you can take the business.
Okay,
The home deduction. Yep,
okay, thanks.
of course. Did anyone else have any other questions on specific deductions I didn't touch on? I mean, this is a hard general topic to jump into, but if you had any questions, I'm happy to try to answer.
Thank you, Kara, that helped a lot.
Of course. So I put my phone number and my email in the chat. Happy to connect with anyone separately with specific questions.
Thank you so much. Have a wonderful day.
Thank you.